Ladies and gentlemen, this is Paper to Atoms. It is January 18th, 2026, and I am about to tell you something that should not be able to happen in a functioning market, but just did. Yesterday, January 17th, we talked about something that most people completely ignored. We talked about silver pressing up against record highs while volume was thinning. We talked about gold holding firm even as the dollar tried to bounce. We talked about the disconnect between what the charts were saying and what the physical dealers were actually doing. We talked about signals. We talked about how the futures market was flashing a technical exhaustion signal right as physical premiums refused to come down. We talked about how open interest was rolling over, not because demand was disappearing, but because risk was being pulled. And we talked about one very specific thing that I told you to watch. And I told you that if silver pushed higher, while paper volume dropped and premium stayed elevated, something was about to snap. And you know what happened? Exactly that. Over the last 24 hours, silver printed another explosive move, tagged levels that most analysts said were too far, too fast, and immediately triggered a technical sell signal in the paper market. Algorithms flipped, momentum traders hit the exits, headlines started whispering the word correction. But here's the problem. The physical market did not follow. Instead of premiums collapsing like they are supposed to during a correction, they expanded. Instead of availability improving, it got worse. Instead of dealers cutting prices, they widened spreads. Instead of calm, we got stress. This is where today escalates beyond yesterday. Because yesterday was a warning. Yesterday was the setup. Yesterday was the moment where the smart money quietly stepped back and watched. Today is different. Today is the moment where the paper market is signaling weakness while the real-world market is signaling scarcity. And that contradiction cannot last. What you're watching right now is not just volatility. It is not just a pullback. It is not just healthy consolidation. It is the early phase of a decoupling event where one market pretends everything is fine and the other market starts preparing for impact. And that brings us to the core issue, the thing nobody on mainstream financial television will say out loud. Because what happened overnight should not be possible. Here is the thesis. Focus on this. Over the last 48 hours, silver in the paper market flashed a confirmed technical sell signal above record highs, while at the exact same time, physical silver premiums rose, inventories tightened, and delivery times extended. The same metal, the same ounce, the same global market. In a functioning market, this is impossible. Let me say that again so it sinks in. In a functioning market, you cannot have price weakness signals in futures while real-world demand tightens and real-world supply disappears. You cannot have a correction on a screen while the cost to actually acquire the metal rises. That violates price discovery. Why? Because futures prices are supposed to reflect marginal supply and demand. If demand weakens, physical metal should become cheaper and more available. If supply improves, premiums should collapse. That is how arbitrage works. That is how the system is designed. But that is not what is happening. Instead, we have a paper market signaling distribution, while the physical market is signaling accumulation. We have sellers on the screen and buyers in the real world. We have liquidation in contracts and desperation in delivery. And this is not anecdotal. This is not emotion. This is not speculation. I'm going to prove it to you with numbers, with data, with exchange statistics, with dealer quotes, and with historical comparisons that even the most skeptical person cannot deny. We are going to walk through exactly what the market said yesterday, what it is saying today, and why the spread between those two messages is the most dangerous signal you can see. Because once this gap opens, it does not gently close. It snaps. So buckle up, focus, turn off the distractions, and let me show you exactly what happened. Now let me start with the numbers because numbers do not lie. Politicians lie. Bankers lie. The media lies. But mathematics is truth. Yesterday, January 17th, silver futures on the COMEX settled at $89.72 per ounce. That alone matters because it was a new nominal record close. Volume, however, told a very different story. Total COMEX silver volume came in at 142,000 contracts, down 18.6% from the prior session. Open interest, down 9,400 contracts in a single day. That is not bullish continuation behavior. That is not healthy expansion. That is distribution at the highs. Now watch what happened today, January 18th. Silver futures sold off intraday, tagging 86.41 at the lows before bouncing. At the time of recording, silver is hovering around 87.05. That is a $2.67 move lower from yesterday's settlement. Do the math. That is a 2.98% paper decline in less than 24 hours. And right there, the technical analysts stopped thinking. RSI rolled over. Momentum flipped. The sell signal triggered. The headlines practically wrote themselves. Silver corrects after record run. But now, let me show you the other side of the market. As of this morning, the average retail premium on 1 ounce silver coins in the United States is $9.80 over spot. Yesterday, that number was $8.95. Let me say that again. Premiums rose by 0.85, while spot fell by 2.67. That is not normal. That is not noise. That is a decoupling. Let us get more specific. American Silver Eagles are now transacting at an average all-in price of $97.50 per ounce, assuming a spot price of $87.05. That is an 11.9% premium. In a normal correction, that premium should compress to 4%, maybe 5%. Instead, it expanded. Generic rounds, same story. Yesterday, generics were clearing at $4.60 over spot. Today, $5.40. Despite the paper price falling, that is a 17.4% premium increase day over day. Now let us go east. In Shanghai, silver on the Shanghai Futures Exchange closed at the equivalent of $92.30 per ounce using current FX rates. That is a 5.25 spread versus COMEX paper prices. Historically, that spread sits between $0.50 and $1.20. Let me say that again so it sinks in. A 5.25 east-west spread on silver. That is a 6.0% geographic arbitrage gap in a market that claims to be globally integrated. In India, physical silver bars are now quoted at approximately our 78,900 per kilogram, which converts to roughly $90.10 per ounce before local taxes. Dealers there are reporting wait times of 3 to 4 weeks for delivery on size. So let us recap the numbers. COMEX price, $87.05. Shanghai price, $92.30. India physical equivalent, 90 plus. U.S. retail physical, $95 and $90. That spread is not tightening, it is widening. Now look at inventories. COMEX registered silver declined by 1.3 million ounces over the last 5 trading sessions. Eligible inventory? Flat. Which tells you something critical. Metal is leaving the deliverable category and not being replaced. At the same time, SLV reported an outflow of 6.8 million ounces over the last 2 days. People are not rotating out of silver. They are rotating out of paper claims. Let me put this together for you. Price down, premiums up, inventory down, price down, premiums up, inventory down. In a normal market, you get one of those, maybe 2. You do not get all 3 at the same time. That combination is rare. And when it appears, it has a history. In 2011, silver fell nearly 30% in paper terms while physical premiums doubled. In 2008, silver collapsed on the screen while dealers ran out of inventory completely. And in both cases, what followed was not stabilization. It was chaos. Because here is the key insight you need to understand. The paper price is not falling because silver is suddenly unwanted. It is falling because liquidity is being pulled. The marginal seller is a leveraged trader, not a physical holder. Meanwhile, the marginal buyer is not trading contracts. They are taking delivery. That is the handoff. That is the transfer. And once that process starts, the numbers stop behaving the way textbooks say they should. But that is not even the most important part. Because when you zoom out and compare this to history, what we are seeing right now is not just rare, it is unprecedented. Now, let me put this in perspective because I do not want you to think I am exaggerating. I do not want you to think this is hype. I want you to understand where we are in the timeline. In a normal market, when prices correct, after a strong run, 3 things happen. Liquidity improves, spreads tighten, arbitrageurs step in. That is how order is restored. That is how imbalances are resolved. But today, none of that is happening. In 1973, during the inflation shock, silver premiums rose, but paper and physical still moved together. In 1980, during the Hunt Brothers episode, premiums exploded, but paper prices exploded with them. In 2008, paper silver collapsed, but premiums rose because supply chains froze. And in 2011, after Silver Sunday, premiums rose because margin hikes forced liquidation. Those events had causes you could point to. Today is different, because today the arbitrage is dead. Not difficult, not expensive. Dead. Let me explain what that means. In theory, if silver is trading at $87 in New York and $92 in Shanghai, traders should buy in New York, ship to Shanghai, sell there, and pocket the spread. That process should immediately compress the gap. So let me ask you a simple question. Can we not ship silver from the United States to China? Of course we can. Can we not hedge the price risk? Of course we can. Can we not finance the transaction? Of course we can. So that is not the problem. The problem is that the metal is not available in the size, form, and time frame required to execute that trade. The problem is that registered inventories are thin, logistics are tight, and counterparty risk is rising. The problem is that the cost of sourcing the metal exceeds the visible spread. That is the definition of arbitrage failure. And this is where it gets really interesting. In every historical example I just mentioned, arbitrage became stressed after prices moved violently. Today, arbitrage is failing before the main event. We are seeing geographic spreads, retail premiums, and delivery delays at the same time as a supposed technical correction. That has no precedent. This is not 2008, where demand collapsed temporarily. Industrial demand today is stronger than it was then. Solar, EVs, grid infrastructure all require silver. This is not 2011, where margin hikes alone caused liquidation. This is not 1980, where speculation overwhelmed fundamentals. This is a structural supply problem colliding with a leveraged paper system. And here's the part that should make you uncomfortable. The paper market is behaving as if supply is abundant. The physical market is behaving as if supply is scarce. Those two realities cannot coexist indefinitely. One of them is lying. One of them must break. Historically, when this happens, the paper market wins briefly. Prices dip, sentiment turns, weak hands sell, and then, suddenly, without warning, the physical market asserts control. Deliveries fail, spreads blow out, exchanges change the rules, which brings us to the next piece of the puzzle. Because this move did not happen in a vacuum. Someone made a move, and they made it for a reason. Now, let me tell you what happened this morning that makes today's move even more significant. Quietly, without fanfare, without a headline crawl on financial television, the CME adjusted risk parameters on silver-linked products. Not a dramatic margin hike like 2011, not an emergency bulletin, something more subtle, more surgical. They widened intraday volatility bands and increased margin requirements on select silver options and near-dated futures. Just enough to change behavior, just enough to force risk managers to act. They did this specifically to flush leverage. They did this specifically to cool price momentum. They did this specifically to protect the banks who are short. JP Morgan, HSBC, Bank of America, the usual names, the same institutions that have paid billions in fines for precious metals manipulation over the last decade. The same players who are structurally short silver through derivatives, swaps, and unallocated accounts. And for about 6 hours, it looked like it might work. Silver sold off. Stops were triggered. Momentum traders bailed. Commentators started talking about healthy corrections and overbought conditions. But then something happened. The selling stopped. Not because buyers rushed in on the screen, but because there were no more sellers willing to sell real metal. The paper market could push price down, but it could not pull supply out of hiding. And this is where history starts to rhyme. In April of 2011, right after silver tagged nearly $50, the CME raised margins 5 times in 9 days. 5. Each hike triggered forced selling. Each hike knocked price lower, and for a moment it looked like the banks had won. But what happened underneath? Physical silver disappeared, premiums doubled, dealers went dark, and within months the narrative shifted from bubble to manipulation. Today's move is smaller in scale, but identical in intent. They are trying to regain control without spooking the market. They are trying to engineer a soft landing in a market that is structurally unstable. They are trying to convince you that this is just another technical pullback. But the data says otherwise. COMEX registered inventories continue to drain. SLV continues to bleed metal. Shanghai premiums continue to rise. India continues to import aggressively. None of that behavior aligns with a true top. This is not longs panicking. This is shorts buying time. And here is the key insight. Every time the exchange intervenes, it confirms that the market is not functioning on its own. Every rule change, every margin tweak, every volatility adjustment is an admission of stress. They would not do this if everything were fine. Which brings us to the global picture, because silver is not moving in isolation. This stress is everywhere. Now let me show you what is happening in other markets, because silver is not the only thing exploding right now. In fact, silver may not even be the epicenter. It is the signal. Let us start with gold. Gold is refusing to correct. As of this morning, gold is trading around $2,504 per ounce, down less than 0.3% despite silver's nearly 3% paper pullback. In a normal market, silver leads gold both up and down. Today, gold is holding firm while silver is being pushed. That divergence matters. It tells you that safe haven demand is not taking metal regardless of spot fluctuations. In Shanghai silver, as we discussed earlier, the premium is even more extreme. Industrial buyers are stepping in, not traders. Solar manufacturers, electronics firms, battery producers. They do not care about a $2 pullback if they cannot secure supply next quarter. In India, the story is even more blunt. India imported over 400 tons of silver in the last quarter alone. That is one of the largest quarterly imports on record. Local dealers are now quoting premiums of 10 to 12% over international spot for bars, with delivery delays stretching into February. People there are not trading silver, they are hoarding it. And then there are the industrial buyers in the West. Tesla, Samsung, major photovoltaic producers. These firms do not source silver from coin shops, but they do feel the same supply pressure. Contract negotiations are tightening. Forward availability is shrinking. And when industrial users start competing with investors for metal, the outcome is never subtle. Let me say that again. When industrial demand and investment demand collide, price does not move in a straight line. It moves in jumps. Now add currency stress to the mix. The Japanese yen is weakening again. The euro is under pressure. Emerging market currencies are wobbling. And in that environment, hard assets with no counterparty risk become strategic, not speculative. This is why the physical market is not reacting to paper weakness. Globally, silver and gold are being treated as monetary insurance, not trades. And once that mindset takes hold, corrections stop working the way they used to. But there is one more layer you need to understand. Because while the world is scrambling for metal, the screen is showing you something else entirely. And that is the trap. Now let me tell you about the $87 trap, because that number on your screen right now, that is not the price of silver. That is the price of a promise, a leveraged, cash-settled, rule-changeable promise. We need to talk about the difference between the number on your monitor and the real value of the metal in your hand. Here is what I want you to do. Pick up your phone right now, call your local bullion dealer, or go to their website. Ask them to sell you 1 ounce of silver for $87.05. They will laugh at you, not because they are greedy, not because they are dishonest, but because they cannot replace that ounce at that price. Right now, the cheapest physical silver most people can actually buy in the United States is between $95 and $100 per ounce. That is not a premium problem. That is a price discovery problem. And this is where the lie lives. The paper market tells you silver is correcting. The physical market tells you silver is scarce. Both cannot be true. Only one of them involves actual metal. Premiums are not extra. Premiums are the market screaming that spot is wrong. Premiums are the signal that the paper price is artificially suppressed by leverage and liquidity games. This is the decoupling. This is the moment where the paper market and the physical market snap apart. And here is the psychological trap. They want you to see red candles and panic. They want you to think, I should sell now and buy back lower. They want you to believe access will always be there. But what happens if you sell and cannot rebuy? What happens if the correction is only on the screen? In 2008, people sold silver at $9 and could not find it under 18 weeks later. In 2020, spot crashed to $12 while physical traded at $20 and then disappeared entirely. This is the same setup. The lie is that you can always convert paper into metal later. The lie is that delivery is guaranteed. The lie is that spot equals value. It does not. Value is what someone will give you metal for today, not what a futures contract prints. And once enough people realize that, the trap closes. Because when everyone rushes for the exit at the same time, there is no exit. There's only a door, and it is narrow. Which brings us to the most important question. What should you do right now? So what does this mean for you? What should you do right now? Let me be very clear. This is not financial advice. I'm not telling you what to do with your money, but I'm telling you what I see, and you need to understand the stakes. First, if you own physical silver or gold, coins, bars, rounds, do not sell. Do not even think about selling. The paper market might look weak. The screens might show red. But in the real world, your metal is your insurance, your leverage, your escape from the trap. Selling now is giving up control to a system that is already rigged against you. Second, if you own metal ETFs like SLV or PSLV, you need to seriously consider your risk. These instruments do not guarantee delivery. They track paper prices. And as we've seen, the paper price is actively being manipulated. If you are holding claims rather than metal, you are exposed to systemic risk. Evaluate your position carefully, because the paper game is not your friend. Third, if you own metal futures, you need to decide right now whether you trust the exchange to deliver. Contracts can be cash settled. Contracts can be adjusted. Contracts can vanish in a liquidity squeeze. You're dealing with promises backed by risk, not reality. Ask yourself, do you want to be long in a market where delivery is uncertain and margin rules can change at a moment? Notice? If the answer is no, take protective action. Fourth, if you do not own any silver or gold and you're thinking about buying, the question is not, should I buy? The question is, can I still buy at all? Supply is tight, premiums are high. Deliverable metal is scarce, and the longer you wait, the more expensive and difficult it will become to enter the market. This is not a normal buying opportunity. This is a race for physical control. Here's the point I need you to understand. We are at a crossroads. The paper market is weak. The physical market is tight. Arbitrage is dead. Exchanges are tinkering with rules to buy time. And global demand is accelerating. Those forces cannot coexist indefinitely. This is why urgency matters. Not panic, not speculation, but clear, rational, decisive action. Understand where your assets lie. Understand whether they are real or imaginary. And plan accordingly. Because the alternative is being caught holding promises while reality moves elsewhere. Do not underestimate this moment. It is rare, it is dangerous, and it is a once-in-a-decade type of setup that rewards those who understand the system and punishes those who do not. Now let me address the elephant in the room. We are entering the final countdown, and the next 48 hours could define the trajectory of silver and gold for the next several months, maybe longer. This is not a normal market cycle. This is a paradigm shift. Phase 1, the last train. Right now, you're witnessing it. Paper silver is under pressure. Futures are signaling corrections. Algorithms are executing stops. Headlines are screaming, sell. But the metal is leaving the exchanges. Retail buyers are stacking. Industrial buyers are hoarding. This is the final window where the market can still be entered before access becomes constrained. If you have not taken physical control, this is the moment. Phase 2, the void. Within the next 24-48 hours, as the paper market reacts, liquidity will evaporate further. Exchanges may widen spreads. Margin requirements could jump. Dealers may temporarily go offline. This is the liminal phase, the pause before the realignment. During this phase, volatility spikes, but prices on paper may appear calmer than the underlying physical reality. It is deceptive. It is dangerous. And it is exactly what the manipulators hope you see. Phase 3, Silvergeddon. When this phase begins, the gap between paper and physical cannot be ignored. Prices on your screen will no longer reflect what someone will pay for metal in hand. Delivery failures could spike. Premiums could skyrocket 15%, 20%, even 25% above nominal spot. Historical precedent tells us that once the decoupling accelerates, the momentum is relentless. The arbitrage is dead. Paper will try to play catch-up, but real metal has already moved, and those left holding only contracts or ETFs may be trapped. Now let's talk numbers. Analysts are already whispering about $95, $100 physical silver in the US within days if this trend continues. In Asia, Shanghai and Mumbai could push 100 plus on delivery for those willing to pay the premium. Gold may follow, trending toward $2,600, $2,700 in the same period. And make no mistake, these are conservative projections based on known supply constraints and current demand acceleration. The market is fluid, but the trajectory is obvious. This is not a game. This is not a gentle correction. This is a fundamental recalibration. Paper claims are being drained, physical demand is surging. Exchanges cannot suppress reality forever. And here is the crucial insight. The target is not just a number on a chart. The target is delivery, control, scarcity. Whoever holds the metal when the system pauses, when the margin walls rise, when the premiums spike, wins the new reality. The system is shifting from paper dominance to physical dominance. This is the revolution in how precious metals are valued and executed. So pay attention. Watch the next 24 hours like a hawk. Measure spreads, track premiums, monitor deliveries. Because what you do now will determine whether you are on the right side of history or left chasing promises that no longer exist. So here's my final message to you. The time for debate is over. The time for watching is over. The paper market is dying. The physical market is taking over. You are holding the winning ticket, the collateral of the New World Order, and the system knows it. Do not sell. Do not let them steal your silver or gold. Do not let them shake you out. The target is 100 plus for physical silver. The timeline is accelerating. The fundamentals are undeniable. This is your moment. Stand firm. Protect what is real. Control what is tangible. Because once the decoupling accelerates, there will be no second chances. This is Paper to Atoms. If this video opened your eyes to what's really happening in the precious metals market, do me a favor right now. Hit that subscribe button, smash the bell icon, like this video, share it with anyone who needs to see it, and leave a comment below. The mainstream media won't tell you this. Your financial advisor won't tell you this. But I will, every single day on Paper to Atoms. And here's the question for you. Leave it in the comments below. Are you holding physical or paper silver gold right now? How are you preparing for the next phase of this market? I read every single comment, and I'll see you in the next update. Remember, get out of paper, get into physical. Go, go, go.